Good afternoon, good evening, ladies and gentlemen. Thank you very much for joining us for our session this afternoon, this evening. As you can see from the slide in front of you, our topic at this session is global trade, customs and import developments. This is the second session of a 6-session series in our mid-year global trade conference. I hope many of you were able to join us earlier today for a program on export control developments. And during the course of the remaining sessions, we will later this afternoon have a focus on import-export developments with respect to China. And then tomorrow focus extensively on sanctions and counter-sanctions between various Western countries and Russia as a result of the events over the last 4 or 5 months in Ukraine. And we will also conclude our session tomorrow with a discussion of export and sanctions enforcement activities. So that's our overall program. As I say, today's program is on customs and import developments. We're going to focus on developments in the United States, in Canada, Mexico, UK, and the European Union. As before we start into the program, let me just note a couple of housekeeping matters. First, we really do want to make this program as helpful to all of you as possible. I hope that you all will have seen an email coming from us, from Baker and McKenzie yesterday, with all of the slide materials, the presentation materials for this conference. If you did not receive it, Liz Rittinger is going to post a link in the chat where you can download these materials so that you have them as a reference point or as we go along through the session. Correspondingly, we are recording the program, and for those interested, we will be very pleased to make the recordings available if you want to have the discussions for a point of reference or for sharing with your colleagues at a later date. Consistent with the theme of trying to make this as helpful as possible, we very much invite and encourage your questions and comments on the program. Please use the Q&A button for submitting questions, and we will try at the conclusion of the session to handle as many of those questions as we can. If time does not permit us to address all of the questions, we will revert to you by email individually with responses to your questions following the conference. And similarly, of course, if any questions might involve something that is confidential or sensitive, just please let us know and we will revert to those by email only. The program has been approved. The program has been approved for continuing legal education and other continuing education programs. In the materials that were sent out yesterday, there is a sign-up form for that continuing education credit. Please do return it to us within 72 hours so we can make sure that you receive the continuing legal education that you require for this program. Now, I guess finally, we will, some of us will be presenting from remote locations from home or otherwise, so please do indulge us and forgive us if there's any kind of background noise, a doorbell with the Amazon delivery or a dog barking or something like that. Well, with all that, now it is my great pleasure and privilege to introduce my colleagues who have very graciously agreed to give their time and share their expertise with us on these very important topics. So let me please introduce Meredith Dement, one of our partners from our Washington office. Christine Strayfeld, also a partner in our Washington office, both leaders of our US-based international trade practice. Nicole Looks, a partner in our Amsterdam office, and Jenny Revis, a partner in our London office, the co-chairs of our European customs and trade practice. Adriana Ibarra, a partner in our Mexico City office, and Jose Pepe Hoyos, also a partner in our Mexico City office, our colleagues leading our Mexico and indeed our what we used to call our NAFTANian practice. And finally, Brian Kasich, one of the partners from our Toronto office and our leading trade partner in Canada. So that's the team, the cast of characters who will be presenting in the course of the next hour and so. And let me now turn it over to Meredith to lead us through a discussion of this very interesting area of the UFLPA, which just went into effect last month. Meredith?
Thank you very much, John, and welcome everyone to the session today. Starting with the UFLPA, the Uyghur Forced Labor Prevention Act, certainly something that's of critical concern to US importers and multinational enterprises right now. It entered into force, as I'm sure many of you know, on June 21st, 2022. And it's of great concern because it creates a rebuttable presumption that merchandise mined, produced, or manufactured wholly or in part in the Xinjiang Uyghur Autonomous Region of the People's Republic of China is in fact produced by forced labor and is therefore banned from importation into the United States pursuant to Section 307 of the Tariff Act of 1930, which of course is the primary statute in the United States banning the importation of merchandise manufactured with forced labor. So the question is then, what do importers need to be prepared to do to overcome the rebuttable presumption, or as the statute terms it, obtain an exception to the rebuttable presumption? And there are three things that an importer needs to be able to demonstrate to US Customs and Border Protection. The first is that the importer has fully complied with the UFLPA guidance that's been issued and any implementing regulations. And of course, to date, we have not seen implementing regulations, but we'll discuss shortly the UFLPA guidance. The second is to respond completely and substantively to any requests for information that are issued by US Customs and Border Protection. And third, but most importantly, is to demonstrate with clear and convincing evidence, which is a very high evidentiary standard in the United States, that the merchandise was not produced wholly or in part with forced labor. Next slide, please. So I do want to take a brief moment to remind our audience about the scope of the UFLPA. It is very broad. It does supersede the pre-existing withhold release orders that I'm sure many of you are familiar with that were related to products tied to Xinjiang as of the effective date, June 21st, 2022. And now imports will be under the purview of the UFLPA and subject to the rebuttable presumption. Also bear in mind that it applies to all merchandise being imported into the United States, whether that's an informal Section 321 entry that's valued at $800 or less. So it's a broad application to all imports. And we've also received questions about potential exceptions under the law, particularly in the context of de minimis forced labor content thresholds. Note that these do not exist in the statute. And to date, we've had no indication from US Customs and Border Protection that they have an intention to create such a de minimis forced labor content threshold. Next slide, please. I also want to walk through briefly the enforcement mechanisms for the UFLPA and what importers can expect if they've not yet received an enforcement under the statute. So CBP is authorized under its statutes to detain, exclude, or seize and forfeit merchandise that's detained under the UFLPA. Now, a detention means that a customs importer will receive a notice of detention, and it will have 30 days to respond to that notice. If CBP, US Customs and Border Protection, issues an exclusion determination, then that is a protestable decision, meaning that the importer will need to wait for that entry to liquidate and will then have 180 days to file a protest to challenge that exclusion determination if it so chooses. If Customs chooses to seize and subject the merchandise to a forfeiture action, then the importer will have to follow the administrative forfeiture proceedings. Typically, you'll have 30 days to respond to the notice of seizure with a petition for remission of the seizure. And if that's unsuccessful, then an importer will have a further 60 days to file a supplemental petition if necessary. Bear in mind that regardless of the form of the detention, whether it's a detention or an exclusion, an importer has the right to export the merchandise at any time prior to the merchandise being seized in the United States. Next slide, please. So the key piece here that everyone is talking about and everyone is concerned about, of course, is how you rebut the presumption. And remember, of course, that I outlined those three things that the importer must demonstrate in order to get the exception or rebut the presumption. The first of which was to follow the UFLPA guidance. And that guidance has taken the form of the enforcement strategy that was published earlier in June by the Forced Labor Enforcement Task Force. And that strategy outlines a number of things to include 3 categories of evidence that an importer should be able to present to obtain the release of merchandise or to be granted that exception. The first category is due diligence, supply chain tracing, and supply chain management measures implemented by the importer. In other words, what does your internal controls, what does your compliance program look like with regard to forced labor? The second 2 are overlapping. The importer needs to be able to demonstrate either that the goods were not manufactured in Xinjiang or were manufactured wholly outside of Xinjiang, or it needs to be able to demonstrate with clear and convincing evidence that those goods were not produced wholly or in part with forced labor. Next slide, please. So this is a breakdown of that first prong, right? These are the 3 categories identified in the Forced Labor Enforcement Task Force enforcement strategy of what should be in the importer's compliance program with regards to forced labor to mitigate the risk of forced labor in the supply chain. Due diligence is really focused on what elements exist in that compliance program. So is the importer engaging with its vendors? Is it assessing the risk that those vendors present from a forced labor perspective? Does it have a vendor code of conduct that it's submitting to its vendors and requiring them to acknowledge and abide by? What steps is it taking to monitor compliance and remediate any indications or presence of forced labor in its supply chain? Supply chain tracing is critically important here because it is crucial to demonstrating that goods are not either produced in Xinjiang or produced with forced labor. And the agencies involved have made it very clear that the burden on an importer is to map the entire supply chain without exception, meaning identifying all suppliers, all work performed in the production process, the roles of all of those parties, and tracing all raw materials and inputs from their source through to the finished good that's actually being imported into the United States. The supply chain management is really more process focused. So it's looking at how the importer is putting into practice the due diligence steps that form its compliance program. Next slide, please. So the most critical piece here, of course, is how the importer can demonstrate with clear and convincing evidence that goods are not produced by forced labor if they are subject, in fact, to a detention or an exclusion. Of course, there's the supply chain mapping that we just discussed, but there are other elements that CBP will expect an importer to be able to demonstrate. First, they'll expect an importer to be able to show the origin and residency status of workers in that supply chain. They'll expect importers to be able to demonstrate worker output, that is, how many workers are there with different vendors? How many hours are those vendors working? They'll expect evidence of recruiting practices that are in place by their suppliers or by agents engaged by those suppliers. So what types of programs are in place? What are the methods of recruitment? Is the government involved, the government of China involved in those recruiting practices? That's an indication there may be forced labor. Is there surveillance of their working or living conditions? What are those living conditions? Are there restrictions on movement? And being able to document that the importer has actually reviewed those different indicators will be important. And finally, does the importer engage a third party or conduct itself any form of auditing? And again, this is sort of a difficult area now because of the challenges placed on audits in the Xinjiang region and in China generally. So note that CBP does view such audit reports with a little bit of suspicion, and it will be incumbent upon importers to demonstrate not only that they have that audit report, but that it was performed without government interference. Next slide, please. I do want to briefly mention that CBP also has issued operational guidance. I don't want to dwell on this too much, but note that it does mirror the enforcement strategy that was published on the Department of Homeland Security's website, the Forced Labor Enforcement Task Force enforcement strategy. It also does give a little bit more color and detail on the types of documents that importers should be prepared to provide in the event of a detention or an inquiry, but only with regard to some of those high priority products, high risk products that were previously identified in the context of withhold release orders like cotton, polysilicon, and tomatoes. And next slide, please. So I'd like to conclude this part of the presentation by identifying some of the different risks and challenges that exist when trying to comply with UFLPA. Certainly, this is an enforcement priority that we think is going to continue, and enforcement is going to increase in this space. Customs has made it clear that for targeting purposes, it will be increasing its resources, looking to deploy more technologically advanced methods to detect forced labor and bad actors in supply chains. So we can expect that targeting to continue. It's also challenging that that targeting does tend to shift, and it's not always clear to any given importer what the source of information is that forms the reasonable basis for a detention. So that is one challenge. Another challenge is actually performing due diligence. There are things that are happening internally in China that present practical obstacles to collecting the type of information importers need. For example, China's anti-foreign sanctions law, its more recent data security law, that creates some restrictions on obtaining information, but also on an importer's ability to demonstrate the credibility of that information. And I say that particularly in the context of audits. And then finally, there are reputational risks and legal risks associated here. Of course, reputational, both if you attempt to comply aggressively because of potential backlash in China, which we've seen with other companies, but also certainly if you don't comply, what are the reputational risks with your suppliers, your downstream customers, and of course, with the US government and in other jurisdictions. And finally, legal uncertainty that's created here. There's always the difficulty of proving a negative, and that is essentially what the law requires. There's also the concern about what the impact of detentions are on contractual obligations to fulfill orders. And then finally, considerations need to be made for which parties in negotiating contracts will bear the risk related to this type of enforcement. How will companies craft indemnification clauses and warranties in those contracts? So there are a lot of things that need to be taken into consideration when preparing oneself or responding to an inquiry under the UFLPA, or in fact, to obtaining the release of that merchandise. I'll now turn it over to my colleague, Brian, in Canada to talk about some of the ex-US forced labor concerns.
Many thanks, Meredith. With respect to Canada, I just wanted to mention that, Canada appears to be moving ahead with the introduction of legislation targeting forced and child labor, the use of forced and child labor in supply chains. And this particular legislation was introduced twice before, but failed to make it through the parliamentary process. But with this third attempt, it does now appear that, that this legislation as proposed in this bill S211 is likely to come into force probably sometime within the next year or so. In terms of when it might come into effect, there might be a period of time where it's delayed in terms of coming into effect because certain regulations may need to be prescribed under the Act once it is passed. Just fundamentally, Bill S211, which is titled, as you can see there, it's a bit of a mouthful. It was passed unanimously in the Senate. It originated in the Senate as a Senate bill. It was then passed to the House of Commons for consideration by the members of Parliament. The bill, as it stands today, has already undergone 2 readings in the House of Commons with the members of Parliament, and now it's been sent to committee consideration, where we may see some additional amendments to this legislation before undergoing a 3rd reading and then given a royal assent in order to come into force. Next slide, please. Very quickly, the core element of this legislation as it's currently drafted is to impose an annual reporting obligation on certain entities that will, and this reporting obligation, among other things, will require these reporting entities to outline the steps the entity has taken to prevent and reduce forced or child labor in their supply chains. These reports would be made public, and failure to comply with the reporting obligation could result in the imposition of prescribed offenses. In terms of which entities are currently thought of as being the reporting entities for purposes of this legislation, right now the legislation contemplates Canadian companies listed on Canadian stock exchanges, entities that have been prescribed by regulation, or entities that have a business in Canada, do business in Canada, or have assets in Canada, and based on their financial statements, meet 2 of the following conditions for at least one of the 2 most recent fiscal years. 1, it has at least $20 million in assets, it has generated at least $40 million in revenue, and it employs an average of at least 250 employees. Again, because the legislation is currently still under review, these conditions may change once we see the final text of the legislation, if it does pass and is granted royal assent. In addition to introducing these new reporting obligations, the bill also proposes to amend the customs tariff to incorporate the definitions of forced labor and child labor into the customs tariff, and as well introduce a prohibition on the importation of goods manufactured with child labor. And that tariff item I've shown there is 9897. It currently is in the customs tariff, but currently only prohibits the importation of goods manufactured with forced labor. As Canada moves closer to enacting this legislation, I think it's incumbent upon companies, particularly those that might be the reporting entities, to really begin to assess and understand the risks in their global supply chains. And in fact, even if your company is not one of the reporting entities for purposes of this legislation, because amendments are being made to the customs tariff that would prohibit the importation of goods manufactured using forced or child labor, it's still incumbent upon all importers of goods into Canada to really have an understanding of how their goods are manufactured and how their supply chains are operating. So with that, I'd like to turn it over to Jenny to provide some comments about the EU and the UK.
Thank you, Brian. I think we're a much earlier stage in the EU and the UK compared to what we've seen with the US. But there's certainly a trend to strengthen measures with regards to modern slavery or forced labor. The most sort of ambitious measure that we've seen is at the EU level, with the European Parliament adopting a resolution on the 9th of June 2022, calling for an import ban on products produced with forced labor from entering into the EU market. And following that resolution, the European Commission is expected to present a proposal for a legal instrument to combat forced labor. And we expect that to be presented in September 2022. Once that's been done, then it will need to go through the EU legislative process before it's formally adopted. That's certainly a move towards more of a US style restriction than what we've had so far. At the country level, if we look at the UK first, the UK adopted the Modern Slavery Act, which covers slavery, forced labor, and human trafficking, back in 2015. And that requires companies that carry on business or part of a business in the UK, but have a turnover of more than £36 million to publish an annual statement on transparency in their supply chains. And this can include information about modern slavery policies and due diligence processes. And the idea behind this is that public disclosure should be enough to encourage businesses to conduct due diligence of their supply chains. But much of this, in terms of what they're required to provide in that statement, is still guidance only. So the UK is looking at how it can toughen its modern slavery framework, and it's talked about making it mandatory for businesses to specifically comment on their approach to due diligence. And the UK is also looking to introduce financial penalties for non-compliance. Looking at various EU member states, we have France, Netherlands, Norway, and Germany that have all adopted legislation making human rights due diligence mandatory for large companies. And that's really the picture that we have at the EU-UK level. So some initial measures, not that extensive as we've seen in the UK. On the EU side, we expect something stricter to come into force, at least a proposal to be put through by the European Commission in September and maybe adopted within a year or so, the EU. Thank you. And with that, I'll hand over to Christine for the next part of our presentation.
Thanks very much, Jenny. Well, as we turn into the issues of Section 301 duties, we have to start by acknowledging that companies and supply chains have been grappling with these duties for almost exactly 4 years at this point. And throughout that time, there has been tremendous uncertainty on the scope of the duties, continuation of these duties, the availability of exclusions and potential renewals of those exclusions. And as we sit here today, there continue to be many moving parts and action items. Some of these action items provide opportunities for companies to engage and impact the process, and others require monitoring, awareness, and staying alert for those opportunities to then engage. We're also left to make some best guesses on what will happen next, and we're always happy to take that offline and provide some of that insight to the extent you have specific questions, so please do let us know. But for the next 10 minutes or so, we'll share what we believe that you need to know today and what you should be on the lookout for in both the short and the medium term. So let's start with the potential for tariff relief with respect to some or all of the 301 tariffs. Roughly 15 days ago, there were public reports that the Biden administration is considering tariff relief. Those reports had a couple of components that we wanted to break down for a moment here today. They have been primarily linked to the need for action on inflation, which will perhaps come as no surprise. And the focus of these reports has been on relief for consumer goods. The reports have conflicted somewhat between sources on whether that relief would be quote unquote tiny, i.e. about $10 billion worth in trade covered, or whether they would involve some kind of major rollback, such as more holistic relief with respect to, for example, List 3, which is one of the most substantial tariff measures that's on the books. Another component of these reports has been the all-elusive exclusion process being back on the table and being under consideration by the Biden administration. Many have commented or promised this before, and in fact, quite a few times we've seen this and gone down this trail for the past year and a half. But still, it's worth noting that the possibility and perhaps even the need for exemptions to exist continue to be discussed at the highest levels. Practically speaking, an exclusion process is often considered less exciting as an option for some, given that there are some pretty significant barriers to actually getting relief for importers under a new process. Among those barriers include the time that's needed to process and eventually approve an exclusion. All the while, the duties have to be paid and uncertainty exists on whether retroactive relief would be afforded or whether any relief at all is coming. And in addition, this timing issue is compounded by the fact that the administration would have to anticipate tens of thousands of exclusion requests, even upwards of 60,000 in line with the first round of exclusion requests. And recall that these past exclusions have been processed in waves or phases based on the staggered schedules that existed with the lists themselves, which wouldn't exist in a process that would be implemented going forward now. Other key questions are how likely are exclusions to be actually granted and whether or not the administration will take into account current administration goals, potentially even reconsidering some of the past denials. The expectation is that they will, and this may favor some industries over others. A final component of these reports are that there's a potential new investigation into Chinese subsidies, which by itself could spawn new and different trade measures and are worth keeping an eye on. Action has been reported by the end of the month, so stay tuned for the potential for more tariff relief. A second factor to discuss is List 1 and List 2 potential termination. In May, USTR initiated a review of the tariffs in advance of a statutory expiration, which happens after 4 years and would occur in 2022. The first step under this review is for interested parties who are in support of the tariffs and want them to continue to file comments. That deadline just passed and closed for List 1 and is still open for about a month for List 2. Following that, USTR will open a comment period for those who oppose the continuation of the tariffs. Participating in this process is crucial. It provides a real path to resolution of the tariffs, and it also presents a decision point for USTR on whether to continue those tariffs or not. Now, while useful, list 1 and 2 are the smaller of the lists, with list 3 being the most massive. So let's turn to the HMTX litigation to discuss for just a moment the status of the potential list 3 and list 4A tariffs and decision points there. In the interest of time, I will focus on the highlights of the litigation at this point and over the last 6 months. But again, we'd be happy to flesh out these comments in more detail if there's interest offline. Most are aware of the background of the HMTX litigation, where more than 6,500 plaintiffs have joined, challenging the Trump administration's authority and process for imposing the additional tariffs under List 3 and 4A. And on April 1st, the Court of International Trade issued the first substantial decision in which it remanded back to the agency, USTR, for an explanation of its decisions on those 2 lists. The government currently has until the end of August to file its remand decision, and the case will proceed from there. Let's go on to the next slide, please. The 301 litigation is not the only case with major tariff implications in the past year. There are numerous additional cases, and we'd like to highlight one here involving the safeguard measures on solar panels. In 2 decisions from the Court of International Trade at the end of 2021, the court found first that agency action and then second presidential action was unlawful in reimposing tariffs on bifacial panels following the granting of an exclusion. One of these cases is pending appeal, but it, along with the other cases in the Section 232 tariff context, confirm a few practical points that courts will carefully review the trade remedy actions and will hold agencies to the statutory standards, even closely scrutinizing whether those standards were met, thereby providing meaningful potential relief for importers, and are certainly worth watching. Let's go on to the next slide, please. With that background, let's get into some practical considerations, particularly for importers. The first is participate in the administrative processes that we are describing here. They provide real opportunities for tariff relief, and they provide an opportunity to create a record on which the agency can rely about the impact of these tariffs, in addition to numerous other inflationary points, supply chain disruption points that are also occurring in the market. One that we haven't mentioned yet is currently ongoing before the U.S. International Trade Commission, where through a so-called Section 332 investigation, the ITC is gathering facts from companies on the impact, the practical on-the-ground impact of 301 duties and 232 duties over the past 4 years. This report, without a doubt, will inform USTR's decision on what action the agency should take as the 301 tariffs reach the brink of expiration. So engage in these processes, comment and provide data, and make sure that the unique experience of each industry is known, and it's available to do so on a confidential basis as well. Litigation also matters in this context, and stay on top of developments to ensure that you're filing for relief where necessary and where useful. It is often required in the trade remedies space that you have your own case where you are the plaintiff and preserving your own rights to ensure that you can get relief under some of the orders that are pending, even where they are favorable to an importer. So be sure that you're not missing opportunities in that sense. And finally, duty mitigation matters very much, and in the meantime needs to be a priority strategy. For those who are lucky enough to have an available exclusion under Section 301 from the limited list that came out in October 2021, watch for the application of that exclusion from a Customs Administration standpoint. Have there been any roadblocks, any denials of the use of your exclusion? And if so, take action on a timely basis and ensure that you are monitoring your imports, your brokers, the receipt of any expected refunds, and protest in the event that there have been any issues to an exclusion you believe is available. Also ensure that you've reviewed the list from October 2021. Be sure to consider that you're claiming all available exclusions and that you're taking advantage of any relief that is available. I hope that we've given you enough to think about for the moment. And with that, I'll pass it on to Pepe.
Thanks, Christine. Well, while the USMCA substitutes NAFTA, some of the provisions of NAFTA remained in force for 5 more years so that the authorities of the importing countries are able to review imports that were carried out during these last 5 years of the life of NAFTA. So based on that, the Mexican authorities have been initiating origin verifications under NAFTA for goods that were imported during those last 5 years. For instance, this year, we have been seeing that they are initiating NAFTA verifications for goods that were importing in 2017, 2018, and 2019, and they have still not initiated reviews for imports carried out under the USMCA.
Yes, Pepe, and something that we have seen is that the focus of the Mexican auditors is not necessarily now that importers and suppliers, exporters demonstrate the NAFTA origin of goods. They want to collect omitted taxes. So they are focusing on, they are having a more strict interpretation, and they are focusing on formal and record-keeping requirements.
Exactly. In the past, they were focusing basically in 2 things. First, that the goods were manufactured in the NAFTA territory, and second, the compliance with the NAFTA rule of origin. But as you're saying, now the focus is more strict and more formalistic, and that may lead us to much complicated issues.
Exactly. And then if we move to the next slide regarding the rapid response labor mechanism, this was an additional dispute settlement mechanism that was included in the USMCA provisions in the last minutes of the negotiation. And it basically applies when one of the parties, and this is motivated by a company located in one of the parties, considers that workers on a determined facility are being denied the rights of collective bargaining or free association. The importance of this is that this can lead to not only delay in the final closure of US customs entries, but also loss of preferential tariff benefits, customs penalties, and it can end with the denial of entry of goods that are manufactured in that facility that is where a panel concludes that the facility is not complying with collective bargaining or free association rights. So because this can lead to a denial of preferential duties or of entry of goods from Mexico to the US or Canada, well, to the US mainly, what we are doing is when we review origin, when we do internal origin reviews for clients, we not only review that companies can demonstrate that the goods are NAFTA or USMCA originating now, and that the company has sufficient records to meet record-keeping obligations, but also to review that the company can demonstrate that it is meeting collective bargaining and free association rights of its workers. Next slide, please. There are certain priority sectors that are considered as sectors that manufacture goods. And these include the aerospace, automotive, cosmetics. So many industrial productions can be considered as facilities that can be reviewed. And what we have seen is that these procedures have been initiated by, motivated by competitors located in the US that compete with companies that are manufacturing in Mexico, as Pepe will explain shortly.
Yeah, I mean, we will see this more and more. I mean, what we're seeing is that the rapid response labor mechanism is working. So far, we have seen 4 cases where the rapid response labor mechanism is initiated. You can see them on your screen, and in most of them, most of them have been already resolved. We're seeing raises of salaries, execution of collective bargaining agreements, restatement of workers. Companies are starting to comply with their obligations more and more. So as you were saying, Adriana, I think that it is important to review compliance even more, and not only with the origin part of the equation, but also with the labor part.
Exactly, and moving forward to the next slide, we wanted to talk about the dispute settlement mechanism set forth under Chapter 31 of the USMCA. So Pepe, do you want to comment on
Sure.
the automotive case?
One. Yeah, as you know, one of the most complicated parts of the negotiation of the USMCA, and basically what was the renegotiation of NAFTA, was the rules of origin for the automotive sector. In fact, as we know, these rules of origin were changed in the last minute and prior to the ratification of the agreement. So they have a new formula, an increase on the regional value content, a new component that is the labor value content, a minimum content of originating steel and originating aluminum. So, but besides that, something that we're seeing is that there was a different interpretation by the US government. That is what is being challenged now, what is called the roll-up methodology, that basically considers that if a material is produced in the USMCA and meets the rule of origin applicable to its tariff classification, it should be considered as 100% originating. However, the United States is ignoring that provision, and in the case of certain auto parts, and well, in January 2022, Mexico requested the initiation or the establishment of a panel after some consultations that it had between Mexico and Canada are requested this panel. And what we know is that there's going to be a hearing on that panel in August, and we are expecting to have a resolution in September or October of this year.
And just this morning, we learned that the US just requested consultations on the Chapter 31 with Mexico as a result of considering that Mexico's energy policy is not consistent with Mexico's obligations under the USMCA. This is going to be a very, very interesting case because we don't believe it's very likely that Mexico will change its energy policy during consultations. So most likely this will end up in a panel. Canada has also expressed already its interest in participating in the dispute settlement mechanism. So this demonstrates that the USMCA dispute settlement mechanism is already working and is already generating cases, no? And with this, I'm going to turn it on to Meredith.
Thank you very much, Adriana and Pepe. That was very helpful. And I hate to say it this way, you've almost stolen my thunder, but I'll do my best to give a little bit more color from the US perspective. So I'll start with the rapid response labor mechanism that Adriana and Pepe so usefully described in detail, and only to say that and echo that it is working. The United States and the USTR, the United States Trade Representative, have shown no hesitation in taking cases forward under this mechanism and, for lack of a better word, prosecuting them or resolving them with the help of the Mexican government. So as they noted, 4 cases to date have been brought, 3 successfully resolved. As Pepe noted, that involves new elections, impartial election observers, new collective bargaining agreements, reinstatements, and back pay. So we do think there will be more cases in the future. And the good news is enforcement has not to date that we're aware of resulted in any penalties or blocked imports into the United States, which is important to note. The other thing for US entities to consider, or multinationals that have manufacturing facilities in Mexico is to really understand the mechanism. It can be complicated, but to know that there is the risk that if there are denials of these collective bargaining rights of employees, you may well find yourself at the receiving end of these types of panels, these types of negotiations. Next slide, please. So the next slide that I'd like to discuss is the other dispute settlement matters that are pending involving the United States. Again, Adriana and Pepe already covered this first one, the dispute between the United States and, on the other hand, Mexico and Canada with regard to the automotive rules of origin. Certainly, this is a complicated issue, but it does involve, as they said, the roll-up of components into finished vehicles. Mexico and Canada taking a more flexible approach with the idea that you can apply the calculation of originating materials to the regional value content of the finished vehicle, whereas the United States is more rigidly requiring that in the RVC calculation for a finished vehicle, you should still account for any non-originating materials in those core components that are incorporated into the finished vehicles, right? So we're expecting that decision in September, and that should be an important decision. Other dispute settlement mechanisms, the Canada dairy tariff rate quota. I know Brian will be discussing this in greater detail, but I just wanted to flag for our audience that this was subject to a dispute resolution, a settlement process, and although that panel ruled favorably to the United States, the United States was not happy with how Canada sought to remediate that situation and has in May requested a second consultation on this issue. So we're seeing that the United States is not happy about the allocation of the TRQ, denying access to certain eligible applicants and those conditions that have been applied to the allocation. And then lastly, and most recently resolved, was the Canada solar safeguards that the United States had imposed on solar products from that country. There was a memorandum of understanding that was signed in July to remove those safeguard tariffs on Canadian origin products, while at the same time installing a mechanism designed to ensure that Canadian origin imports of those products do not undermine the global safeguard duties on products from other countries. Next slide, please. And then just briefly to note that there are these other matters that are still pending. Of course, as Adriana noted, the energy policies of Mexico favoring state-owned enterprises and placing US private investment at risk has come to a head today with formal request by USTR for consultations. That's certainly something to keep an eye on, but also concerns by the United States over Canada's digital service tax and that those thresholds effectively target large US digital services providers, as well as the ongoing dispute over Canada softwood lumber. The position of the United States is that those products are subsidized and dumped in the US market. There is, though, a corresponding pressure within the United States to reach agreement with Canada on this issue, because the existing current remedies that are being imposed on those imports from Canada are adding additional pressure to residential construction in the US housing market, on top of inflation and some of the other supply chain challenges that have been experienced in the lumber space. So these are all things to keep an eye on from the US perspective, and I will turn it over to Brian for the Canadian perspective.
Thank you, Meredith. I just want to touch upon, you give a little bit of background on this dairy tariff rate quota dispute with the US. For those of you not familiar or haven't encountered it before, Canada actually has a system of supply management for certain agricultural products that tries to ensure that the domestic supply of these products is kind of matched with domestic demand. And as part of that supply management program, there's this tariff rate quota system that applies to many of these goods. And within the supply management policies is a tariff rate quota system. And under that system, agricultural goods that are classified as being within access commitment tariff items, so you have quota, are subject to much lower rates of duty. And agricultural products that are subject to TRQ but are imported outside of quota are subject to significantly higher rates of duty. And Global Affairs Canada is actually the agency here in Canada that's responsible for administering those import allocations. Some of those import allocations are done on a first come, first serve basis. And with some other products like dairy, that allocation is actually done in a more complicated mechanism where certain quota is reserved and allocated to certain categories of importers. And that the way that dairy is allocated, the quota is allocated for dairy, is an issue that the U.S. has had for a long time. And as Meredith noted, the U.S. requested on May 25th of 2021 that a panel be established under the USMCA in respect of Canada's dairy TRQs. Should mention that prior to the request for the panel, there were requests for consultation, and the dispute couldn't be settled through the consultation process. Now, in December of 2021, the panel issued the final report indicating that yes, the way that Canada sets aside a percentage of the dairy TRQ for certain Canadian processors is inconsistent with the USMCA, and Canada therefore had an obligation to find a way to fix it. And if you read the panel's report, there was some suggestions that there could possibly be a way to reconfigure this import allocation mechanism that would be compliant with USMCA. In early part of 2022, Canada held public consultations with proposals as to how the new allocation policy would work. They issued sort of the final policy in May of 2022, actually on May 16th. And within a matter of days, the US indicated that it rejects Canada's proposal to address the panel findings, notably on the fact that certain applicants remain excluded. So for example, small retailers could not obtain allocation. It still frustrated new entrants since that allocation could not necessarily be given to a party that did not have or had not participated in allocation in the 12-month year prior to the current allocation period. So that policy effectively prevents new entrants from getting a hold of quota. And also the way that Canada was allocating quota, sort of parceling out on a month-by-month basis, was not sort of the way that the US had foreseen. They wanted to see quota being allocated in full at the beginning of each new allocation year. So as Meredith noted, the US has now initiated a second dispute on the TRQ, the dairy TRQ, and we'll see where this will lead. In tandem to this, not surprisingly, New Zealand has announced that it too is challenging Canada's dairy TRQ system under the CPTPP. So it'll be interesting to see how that unfolds as well. Next slide, please. So just in the interest of time, Meredith has already sort of mentioned the dispute over these crystalline silicon photovoltaic products, or the solar products. I would just note again, as Meredith noted in the memorandum of understanding, the safeguard measures have been suspended for Canadian originating product, subject to, of course, an exception that this does not result in a surge of solar products originating in Canada that would essentially undermine the effectiveness of the solar safeguard measure. And so just in the interest of time, I think maybe we'll move on to our next topic regarding customs valuation and transfer pricing. And with that, I'd like to turn it over back to Meredith.
Thank you, Brian. So one thing we do want to highlight here as we come to the close of our presentation is customs valuation and transfer pricing remains globally an issue of challenge for a number of different companies. The intersection between customs and tax in connection with transfer pricing is something that is perceived to be low-hanging fruit very often from the Customs Administration's perspective. Certainly that is true in the United States. So this serves as a reminder to those listening to really ensure that you have your customs experts, your trade compliant experts, corresponding and communicating regularly with your tax colleagues to make sure that you're satisfying the requirements of both regulatory agencies while still achieving your tax transfer pricing objectives. So in the United States, I would point out two challenges. The first is, of course, making sure that you have established to the satisfaction of U.S. Customs and Border Protection that your intercompany transfer price is a supportable transaction value. That is, that it's not influenced by the relationship with the parties and is a valid arm's length price. Under the US statute, there are a number of tests that are applied by US Customs and Border Protection to determine that that is the case, that it is an arm's length price. Won't go into this in detail, but I've highlighted them here. Circumstances of sale test, those test values tests, less utilized test, but still available. The other risk and challenge is accounting for retroactive transfer price adjustments. Those adjustments do need to be accounted for as they do impact customs valuation in the United States. Next slide, please. So in looking at the intersection of customs valuation and transfer pricing, there are a few additional things to bear in mind. The goal, of course, of both customs authorities and tax authorities is to ensure and establish that there's an arm's length price for transactions. There are differences, though, that make it challenging to reconcile the two. Customs tends to focus on individual transactions and commodities. Tax authorities, like the IRS, focus on an entity's financial results and profits. So there are different competing methodologies for evaluating the arm's length nature of a price based on these goals. Please note that in the United States, it remains the rule that reliance exclusively on an advanced pricing agreement with the IRS or on a transfer pricing study that has been prepared for tax purposes only is not sufficient in and of itself to establish that an importer has exercised reasonable care in compliance with its obligation under the customs laws. So it's very important for importers to overlay those transfer pricing policies or advanced pricing agreements with a customs analysis to satisfy the customs rules related to valuation. And lastly, with regard to those retroactive transfer price adjustments, we strongly encourage importers to take advantage of the reconciliation prototype, which essentially flags those entries for value so that importers can go back later and adjust their customs values with the reconciliation process to account for retroactive transfer pricing adjustments. This avoids potential liability both under the customs laws as well as the tax laws in the United States. And with that, I'll turn it back to Brian to talk about some of the transfer pricing considerations in Canada.
Thanks, Meredith. So one topic I wanted to talk about was purchaser in Canada. And in Canada, when you're looking to rely on the transaction value method in order to determine the value for duty of goods imported into Canada, whether those goods are sold to a third party or to a related party, one condition that must be satisfied is that there is a sale for export to a purchaser in Canada. So Canada, through this concept of purchaser in Canada, effectively kind of has a last sale rule. But this concept is very important, and it's actually the definition of purchaser in Canada is found in the value for duty regulations and requires that certain conditions be satisfied in order to be a purchaser in Canada. And I've summarized on the slide there sort of the definition of purchaser in Canada. And some of the terms that appear in the definition are also themselves defined under the regulations, and certain Canadian International Trade Tribunal cases have considered those terms further in terms of what are the indicia in terms of having a permanent establishment in Canada, for example. But fundamentally, if you fail to satisfy the purchaser in Canada condition, you cannot rely on the transaction value method. You may have to value your goods on one or the other alternate methods of valuation prescribed under the Act. And where we often see issues around purchaser in Canada, at least recently, has been with companies looking to either establish new supply chains or change their supply chain into Canada. And what we find is that changes to those structures may impact how the entity that's been established as the Canadian importer operates in such a way that it may no longer qualify as a purchaser in Canada. And so the overall message here is that if you're making changes to your supply chain into Canada and you wish to sell goods using the transaction value method, please keep in mind this concept of purchaser in Canada and ensure that it's satisfied so that you can rely on the transaction value method as your primary method of valuation of your goods. Next slide, please. With respect to transfer pricing adjustments and transfer pricing in general, changes to an organization's transfer pricing can obviously necessitate corresponding adjustments to the values declared on import declarations for goods imported into Canada. And the CBSA has published Customs Memorandum D1345, which addresses and outlines the impact of transfer pricing adjustments and subsequent on value for duty of goods imported into Canada, and the obligations an importer has to report any adjustments of a transfer price and to pay any additional amounts owing as a result of those adjustments. And so in Canada, corrections to import declarations are typically made through a self-adjustment process that's triggered when the importer has reason to believe that their declaration, origin, tariff class, or value for duty is incorrect. And with respect to those, excuse me, with respect to those changes in value, this obligation applies to both corrections that result in amounts payable to the CBSA. So if your transfer price adjustment increases the value for duty of your goods and you owe additional duties and taxes to the government, and those, for example, your adjustments are revenue neutral. No additional amounts are owed to the CBSA, but there has been an adjustment in price. These corrections have to be filed in certain prescribed time limits. With respect to downward transfer price adjustments, I just wanted to note that the D memo has been summarized to kind of provide more commentary on this, but fundamentally, retroactive downward transfer price adjustments will only be taken into account if there was an agreement in writing at the time of importation to later reduce the price paid or payable for imported goods. And so with downward transfer price adjustments, we're seeing the CBSA ask to see if you do have this agreement that contemplates a downward transfer price adjustment. Excuse me. Where a downward transfer price adjustment results in a refund of duties paid, you should note that there is no obligation to file those corrections. In fact, it's voluntary to file that as a refund claim. And you file that separately. If a downward transfer price adjustment results in a refund claim, those are filed separately under what we call Section 74 of the Customs Act. Now, with respect to downward transfer price adjustments that result in refunds, the CBSA has signaled, and it's stated in the D memo, that there will be greater scrutiny applied to those refund requests pursuant to downward transfer price adjustments, particularly those based on the OECD transactional profit methods such as TNMM. And for any of those types of refund requests, the importer will actually be required to demonstrate that the result of applying the downward transfer price adjustment achieves the arm's length range for the profit indicator identified in the related company transfer pricing documentation. And the importer will also be required to demonstrate that the downward transfer price adjustment involved an actual transfer of funds and related to the transaction and was actually shown in the income tax filings with the CRA. And then having demonstrated the above, the CBSA may also require you to present additional information to substantiate that your downward transfer price adjustment also resulted in an uninfluenced price for customs valuation purposes. So something to keep in mind now, and that we're seeing the CBSA be more vigilant on downward transfer price adjustments and requesting more and more information in this regard. With that, I'd like to turn it over to Nicole.
Thanks, Brian. A couple of words and perspectives from the EU and the UK. As you might have experienced, customs valuation can be a pretty complex topic, not easy to solve. In the European Union, the Union Customs Code being the basis regulation for customs does not provide for the possibility of lodging or asking for binding rulings in the area of valuation. The EU only sees that option for binding rulings for binding tariff information, so in the tariff specification area, and to get confirmation on the origin of products. Single member states, however, have chosen a different route and say, despite of lacking EU legislation, they issue nevertheless binding rulings on customs valuation issues like Belgium and the Netherlands. However, only for imports into the individual country. There are now, there is a tendency and a program from the EU Commission to enforce or to put into legal legislation the possibility to ask for a binding valuation ruling throughout the EU. We actually expected to have draft legislation wording already by the end of last year. We haven't seen it yet. Everybody is looking forward to it, so we hope that it will be possible in the EU to ask for binding valuation rulings sooner than later. There is also a tendency in the UK, or very, very far process already, to introduce the possibility for binding valuation rulings. The UK, as Jenny will mention in a couple of minutes, wants to join the CPTPP, and one of the requirements to join is to have a legislation around binding valuation rulings. So there is a great push in the UK to get the possibility and to introduce the instrument of customs valuation rulings very soon. So it's expected that the UK moves here and have some legislation by the end of the year. For the EU, it's a bit uncertain, but we expect in the short term to have the possibility for asking for binding valuation rulings as well. Next slide. As you can see, also in the EU, a very favorite topic is the interplay between transfer pricing and customs valuation. I don't want to repeat what Meredith and Brian already mentioned. Just a couple of words on the two areas where the customs administration actually is looking at. Can the transfer price, which is well documented from a transfer pricing perspective, likewise be used from a customs for customs valuation purposes? And the second big topic is, do retroactive transfer price adjustments have an influence on the value declared on prior imports? On the first topic, we do not want to elaborate on that further, but just a couple of words. Like in the US, if you have got an APA, rulings, TP documentation, it's an indicator that you have got a solid customs value, but it is in no case binding because, as Meredith has mentioned, both areas of laws follow a different strategy when looking for an arm's length price and arm's length comparison. So it's good to have it, but it's in no case binding. So you indeed should overlay that, review that from a customs angle as well, and draw the proper conclusions from a customs perspective. Next slide. On the never-ending story of retroactive transfer price adjustments, the EU, you have to understand, unfortunately does not have a harmonized set of regulations if it comes down to how to handle retroactive transfer price adjustments. So member states can differ in in their practice, how to handle transfer price adjustments. They can differ in the question of, can you balance transfer pricing debits against credits? They can differ with respect to, is only a yearly review done and really looking at the year-end transfer price adjustments, or do transfer price adjustments during a year also have an impact on the correction of prior imports? Practices can also differ with respect to retroactive transfer price adjustments. Do they only have an impact on customs duties or also on import VAT? The very famous European Court of Justice case Hamamatsu was brought up by Germany because Germany has a very rigid interpretation on how to deal with retroactive transfer price adjustments. And the hope was that the Hamamatsu case actually gives an indication to the entire EU on how to handle transfer price adjustments, so that ultimately there can be an harmonized and aligned practice derived from the verdict. Unfortunately, this was not the case. The Hamamatsu case was very cryptic and seems to dismiss the acceptance of the transaction valuation methodology if companies actually operate with retroactive transfer price adjustments, and they would push, according to the current interpretation of Hamamatsu, the parties into using alternative valuation methodologies. It's highly criticized. You see, the Hamamatsu case is already pretty old, but it's still not yet decided. It's now pending at the highest federal finance court in Germany, waiting for a final decision. Until then, unfortunately, you have to look at each individual member state on how the current practice is on how to deal retroactive transfer price adjustment. It seems to be that those countries which have a standard practice to accept incomplete or provisional customs declarations are much more easier in finding a practical solution if it comes down to retroactive transfer price adjustments than the countries which are not so much familiar with incomplete or provisional declarations such as Germany and the UK. So unfortunately on that front, the news is that there are no news. And with that, handing over to Jenny for FTAs.
Thank you very much, Nicole. We've got a couple of minutes left before wrapping up. I wanted to mention a couple of points with regards to free trade agreement developments in the EU and the UK. And the first development really is with the US. There was much hope that the US would be concluding a free trade agreement with the EU, but unfortunately, negotiations were formally closed for that in 2019. And with regards to the UK, the US and UK started free trade agreement negotiations back in May 2020, but no further negotiation rounds have taken place since October 2020, and an agreement is not expected soon. And unfortunately, it's thought that this is because of the fact that the US is currently treating as a priority domestic policy over new trade agreements, and also possibly with regards to tensions between the UK and the EU over the Northern Ireland Protocol, which we'll talk about in a moment. So moving on to other developments between the UK and third countries with regards to free trade agreements. One of the main changes that we're expecting and seeing, if we can move on to the next slide, please, is with regards to the UK's ambition to join the CPTPP, which, as you know, is a trade agreement between 11 countries currently, including Canada, Chile, Japan, and a number of others. And the UK has got ambition to join the CPTPP, has started negotiations for this, and very much hopes that negotiations can be concluded by the end of 2022. And then the final point I wanted to talk about is Brexit. And if we can move on to my final slide with regards to the UK and the situation in Northern Ireland. So many of you will think, well, Brexit is done and over with. It happened on the 1st of January 2021, but unfortunately, a number of Brexit issues are still rumbling along. And the main issue at the moment that's causing tensions between the EU and the UK is the situation with Northern Ireland, where Northern Ireland was a key contentious point in the negotiations for Brexit due to the need to protect the peace agreement that had been concluded between Northern Ireland and Republic of Ireland. And the UK is now looking to change some of the agreements that were made to facilitate movements of goods between mainland Great Britain, the UK, and Northern Ireland remains part of the United Kingdom. And so there are, the UK is looking to introduce different lanes for goods that are intended to stay in Northern Ireland but wouldn't require checks and border controls versus red lanes that would be put in place for goods that are going into Northern Ireland from the UK but ultimately destined for the European Union. And they're also, the UK is looking to have more regulatory flexibility with regards to products moving into Northern Ireland so that all of those products do not need to comply with EU regulatory laws. So a lot of changes that the UK is looking to put in place to make things more flexible for trade with Northern Ireland. It's published a bill which is going through the legislative process in the UK. The EU is very unhappy with that process and has launched infringement proceedings against the UK for not complying with parts of the protocol. And the EU is not prepared to renegotiate that protocol, but has offered to facilitate the implementations of certain areas of that protocol. So this is an area to keep under review, as it's very much a sort of political issue between the UK and the EU in the context of Brexit. And with that, I'll hand back over to John. Thank you.
I think maybe we have just time for one quick question, if I may, before we adjourn. Question posed, and I think this is for Adriana and Pepe. If a company received a NAFTA audit from Mexican customs, should they assume they will be audited for all of 2018 through 2020?
Do you want to respond, Adriana?
I think you're on mute, Adriana. Oops, was there?
Yeah, what we have been discussing is that, well, it would depend on the results of the first verification. I mean, it is not something that is mandatory to continue with an additional verification, but it is likely if the result was negative.
Thank you. Well, I think that brings us really to the hour. So rather than go on any of the other questions, let me again thank the entire panel for their really outstanding presentations this afternoon and this evening on this program. As I mentioned at the outset, this is the second of 3 sessions today. So I hope you will join us in a couple of hours when we switch our focus to China and talk about Chinese import and export developments that may be relevant to your business. With that, again, my thanks, and a special thanks to Liz Rittinger and Anna Discutido, who did all of the logistics to make this program successful. And with that, we should adjourn, and I hope to see you in a couple of hours.